Welcome to the Lend Academy podcast, episode number 58. This is your host, Peter Renton, founder of Lend Academy. Today on the show, I am delighted to welcome Brew Johnson. He is the CEO and co-founder of PeerStreet. Now, PeerStreet are a real estate platform. They've been around for a couple of years. I've found them personally very interesting. They're doing things a little bit different to some of their competitors, and we dig into that in this interview. Particularly, one of their unique differences is how they source deals. They've taken an approach that I haven't seen duplicated anywhere, and so we get into that in quite some detail. We talk about the investor side of their business, their tech side, where they're also very strong, and we get a bit of an idea of what's coming down the track for PeerStreet. Hope you enjoy the show. Welcome to the podcast, Brew.
Thank you. Thanks for having me.
Okay, so let's just kick it off with a bit of background about yourself and how your sort of career arc has gone and how you came to start PeerStreet.
Yeah, it's the company's kind of tied pretty closely to my personal kind of career. So, background-wise, I started my career as a real estate attorney. When I was in law school, I went to law school in 99 to 2001. And when I was in law school, I was planning on doing tech work. And I'd helped my brother found a tech business while I was in law school. And, everything was tech. And I thought I'd get out and be a lawyer and do IPOs and things like that. And maybe then go in-house at a tech company. But when I got out of law school, the dot-com bubble had burst. And the law firm I went to basically just threw me in the real estate department because all the tech work had dried up. And it was one of these really interesting kind of serendipitous things that getting into real estate in 2001, everything was on the upswing in real estate. And so it was a very, very kind of lucky happenstance what happened to me. And then I practiced real estate law until 2001 to late 2005, early 2006. And that was obviously the run-up in the housing bubble and the real estate kind of boom and those happening. And while, the firm I worked at, I represented, all sorts of national home builders, banks, small developers, and just there was a lot of things happening in the marketplace that just didn't make sense to me. And I kind of became obsessed with what was driving this housing boom and the real estate boom. And it led me to the securitization market and a lot of things were happening behind the scenes. And, 2004, 2005, it just seemed like everything was based on kind of smoke and mirrors to me. And I ended up leaving real estate and real estate law, planning on waiting for things to fall apart and maybe doing some sort of vulture fund or do something like that. And so I'd shorted Fannie Mae and all the banks and was going to wait for things I was waiting for the financial crisis to unfold. And luckily, while I was going to wait for that, my brother's tech business that I helped him found was growing very quickly, and he needed help. So I ended up getting back into the tech world and working for him at his company. This was early 2006. We basically decided that it was a good time to sell the company shortly thereafter, mainly because I was convinced that the financial crisis was coming. Right. So we ended up selling that company to Expedia in July of 2008. And so personally being kind of in this weird place of really having a very good understanding of real estate law, the kind of real estate finance markets, and then spending a couple of years in the tech world. At the time, seeing what Lending Club and Prosper were doing in peer-to-peer lending, I thought, as early as 2008, I thought, wow, when the banks go out of business or the banking system is very kind of changed with this financial crisis that I saw coming, if we could do something very similar to that in real estate, it could be a very, very valuable business and very important business to people. So I actually worked up a very similar business plan to this back in 2008, 2009, but for a variety of reasons, the timing wasn't right. So fast forward to 2013, it just seemed like everything had set up perfectly in the marketplace to focus on this business. The tech had come a long way. Lending Club had hit its kind of tipping point, critical mass. What was happening worldwide and marketplace lending and crowdfunding was just clear. It was like the opportunity was ripe. Right.
So then you had some co-founders, I believe. So can you tell us a little bit about how the company actually came into fruition?
Yeah. So 2013, I basically this is when I decided to focus full time on the business and kind of put aside a lot of my real estate, a lot of other stuff I was doing. And then I reached out to my co-founder, Brett Crosby. And that was in early 2014 is when I first reached out to Brett. Brett's an old friend of mine. He had originally founded a company called Urchin Software Corporation, which he was acquired by Google in 2005. Then he turned that into Google Analytics, so the largest web analytics platform in the world.
Mm-hmm.
And then he spent a decade at Google just doing a variety of different things. And I've always just respected Brett. We're old friends, went to college together, and he just was a guy that as soon as I thought of, decided to go focus on his business full time, he was clearly the right choice to be my co-founder.
Right. Okay.
It was an interesting thing though. He has this long and very kind of successful career at Google, and he was very happy there. So originally, I went and kind of pitched him on the idea and convinced him to invest in the business as an angel investor. And then after him getting involved more as an advisor, then it became clear that it was the right opportunity for him to leave Google to come on board. And so that's pretty much what happened.
That's a nice combo you have there with the real estate background and the tech. That certainly helps a lot. So let's just dig in a little bit about PeerStreet. What part of the market are you focused on? Are you doing fix and flips primarily, or where are you focused?
Yeah, the main focus is on single family properties, so fix and flip, short term buy to rent loans. So going up to about 36-month terms, but focus on those single family properties. And me personally, we just think it's this, when underwritten correctly, it's just a fantastic asset class, and it just has very mispriced risk and great risk-adjusted returns for investors. So It's always been our focus. Now, as the business grows, the goal is to provide as much diversity for investors as possible. But it's we feel that the short-term rehab loan, fix and flip loan, and the short-term buy-to-rent loan is just in the current market is the right place for to surface up loans for investors.
Right. Okay. And I just looking at your website, you seem to have a slightly different approach to many other people in the industry. It says, you talk about investing alongside originators. Can you explain how that process works?
Yeah. I mean, from an investor's point of view, or from an investor coming to the site and investing, I mean, things work very similar to Lending Club or Prosper. You sign on, you create an account, you fund your account through PeerStreet's website, but when you fund it, your funds are held at City National Bank. And then if you want to invest in a loan or of 500 loans, it's like clicking a button and selecting stock. So kind of functionally from how it works from investing, it's like E-Trade for investing in real estate debt, or similar to Lending Club and Prosper.
Mm-hmm.
Now, it's the idea of kind of why we structured things on the other side of the marketplace, where we kind of work with these originators or allow investors to invest with these originators. It's really kind of it feeds into our credit and underwriting model. And the space that we're dealing in this rehab or fix and flip lending space, I mean, historically, high quality lenders in this space in real estate have been local real estate experts that have a focus on a geographic area of expertise where they make loans in, which gives them great borrower relationships. They understand their market that they're competing in. And there's a lot of lenders that have been operating on this space for many, many years. But generally, the market is extremely fragmented with local players scattered around the country. So when we look at the marketplace, we thought, as opposed to going out and finding borrowers and originating loans ourselves, it makes much more sense, both from a risk perspective for investors as well as just for a business for PeerStreet's point of view, to work with these existing lenders as opposed to going out and trying to compete with them. And the reason we think it's smarter is that it allows us to create diversification for investors a lot easier. And by working with experts who know their markets and have been operating and lending for a long time, it provides us a higher quality of loans out of the gates coming into PeerStreet's platform.
Okay, so I just want to dig into that a little bit more. You talk about having, investing alongside these originators. Are these just talk me through a typical deal so we can really unpack how it all works.
Yeah, so I mean, a typical deal, one of our originators is out there. He's in the business of making loans to fix and flip operators. So somebody is buying a house, they need a loan for it. They go to one of our origination partners. Our origination partner underwrites that loan, makes a loan to the borrower with their own capital. Then that originator will bring the loan to PeerStreet for inclusion on the marketplace. PeerStreet, we underwrite the loan, re-underwrite the loan as if we were making the loan ourselves. It's a combination of big data analytics, manual underwriting. We send somebody out to the property to put an appraisal on it. And if it meets our underwriting guidelines, then we make it available for investment on PeerStreet. So we say that you're investing alongside the originator of the loan. It's very important for us that the first person who made that loan committed their own capital to make that loan. And then when we bring the loan out on PeerStreet's platform, we require the lender to have skin in the game, meaning that the interests are aligned alongside the investors on the platform.
Right. So what typically, how does it typically work? Is it you trying to get like 25% skin in the game, 50? What do you open up? How much of a loan do you open up to your investors, and how much do you want the lender itself to hold?
Yeah. So, I mean, it varies depending on who the lender is and our track record with the lender and how comfortable we are with the lender, as well as the profile of their particular loan. So all of the lenders have skin in the game in the fact that if they make a loan, there's no obligation for PeerStreet to take the loan and put it on its marketplace. We have the option to take loans that these originators make. So they have skin in the game in every case in the fact that if they make the loan and we don't take it, they're going to be holding that loan themselves. And then depending on the risk profile of a particular loan, it could be, generally it's about 10% of the loan is what we have as skin in the game, where the originator has 10% kind of money at risk, but it varies. Sometimes it could be 0% if it's a very, very safe, secure loan. Sometimes it could be higher than that.
Right. Okay. So the investors on your platform are not necessarily, well, they're not loaning money to the developer who's doing it. They're loaning money to the person who's loaned the money to the developer.
That's right. I mean, really what happens, PeerStreet acquires the loan. I mean, similar to how, I guess one way to look at it from a kind of an expert's point of view, like you, and you understand the process probably better than anybody, similar to how WebBank uses, or Lending Club and Prosper use WebBank as a third party,
right,
to actually make the loan. We look at these local lenders and these originators as our kind of WebBank. And so when the loan is made, PeerStreet makes it available for investment. PeerStreet then acquires the loan, and PeerStreet holds that loan in a bankruptcy remote special purpose entity, and when investors invest in a fractional interest in that loan, they get issued a mortgage dependent note, similar to a borrower dependent note on Lending Club and Prosper.
Right.
But the loan itself, because the loan itself that PeerStreet puts into this securitization, this bankruptcy remote entity, is secured by real estate, we look at it as a lower risk proposition than consumer credit.
Mm-hmm. Mm-hmm. Sure. No, that makes perfect sense. Okay, so then what typical loan terms are we looking at here? These are like at least 6 to 12 months, and what are the interest rates range?
Yeah, so the interest rates range depending on the loan from 6 to 12% is kind of where we've operated. If you look at across the portfolio of loans we've done, the net interest rate to investors is just under 8%, 7.9%. That's across the portfolio. Average 9-month term, and an average 62% loan to value, which is the main risk characteristic in a real estate loan. So, the way we look at it, I think if you look at Lending Club or Prosper's kind of platform-wide interest rates, very, very similar interest rate. But because of the security of the asset, we think that the kind of the risk profile is more akin to like kind of A-graded notes, or the very highest rated notes on Lending Club and Prosper, because of that security with the real estate aspect of it.
Mm-hmm. So I'm curious about the originators. If they send you a loan and you don't put it on your platform, what are their options? Do they? I mean, obviously before you guys came along, they had I presume these people had relationships where they were able to fund their loans. What are their options outside of your platform?
Yeah, so there's kind of different segments of these lenders, these non-bank lenders, and dealing with real estate. And some of these lenders just lend the money and hold the loans to maturity, historically. And there's no kind of consistent market for them to be able to sell loans into kind of consistently to create liquidity for their business. So typically they would make a loan and hold on to that loan until the loan matured. And then when the loan paid off, then they could take that money and go make a new loan. And so, typically they may have investors that they gather together to lend money out of a fund, or they might make loans and kind of put investors into a loan one at a time. So there's a few different channels for how these lenders kind of have capital to go make loans. But the key point for most of these lenders is that it's a very capital intensive business, because they're not a bank. They don't have deposits that they can lever to make loans off of. So it's very capital intensive for them. And generally their cost of capital is very, very high. So by participating with PeerStreet, it really creates benefits for their business, and that it allows them to kind of take money and be able to take investors in loans and then make new loans to other borrowers. And so it kind of creates liquidity for their business. allows them to potentially expand their business if they're high quality or want to. And then for our investors on the flip side, it gives us just a higher quality of deal flow because we're dealing with lenders that have track records and experience and expertise, and also just allows investors to diversify a lot easier across not only just loan type but also lenders, because quality of lenders is a kind of is a real risk mitigant. So if you can diversify across lenders, it provides risk mitigation.
Sure. So then it makes sense because on your website's very investor centric. So you can't really, you're not set up to take borrowers on your website. You're only going to take a borrower who you've vetted and you've had a relationship with that is, it's really it's a hard money lender, I guess. So someone who's a small time developer who's looking to fund their fix and flip, they're not going to come to you. They're going to come to one of your originators, right?
That's right. That's the way it typically works. Now, I mean, borrowers do come to us. They can see the lenders that participate in our platform. They can go contact those lenders directly. So there is, borrowers that come to our platform, they can find lenders that make these type of loans in their area. But our main focus is not going out directly to borrowers.
So what's your revenue model then? Are you taking an origination fee on the loan itself? Where are you making money?
Yeah, similar to Lending Club and Prosper. We charge. There's a servicing spread that's charged to the investors of 1%, and then we participate with the lenders on kind of the fees that are charged to borrowers.
Right. Okay. So, can you just give us some idea of your loan book? You go to your website and you see all the loans that have been fully paid off. Have you had 100% track record as far as loans being paid off? Where are you at?
Yeah, we've had no losses or defaults to date. We've had we've not even had any payments that have been past 30 days delinquent. And part of that, well, it's twofold. The reasons for that is, one is that because we kind of cast a very wide net, and we have many lenders that bring us loans, we can be very selective in the loans that we bring through on the platform because we kind of have a wider funnel effectively. So we kind of we can kind of deal from like a higher quality place out of the gates. We actually looked at this as almost like, if you're looking at kind of creating like a tech platform, which Brett and I both kind of, the goal was to do that. Our whole thing was, it was very important to be able to create value to the participants in the ecosystem. And we looked at it more investor centric of like, okay, how do we provide them as much safety as possible to the investors to help establish our credibility as a platform? And, from day one, we looked at it as like almost like a conflict of interest if we were to go out and find the borrowers directly and make loans to borrowers directly, because to create like scale in this particular asset class, we almost looked at it as like the only way to kind of create a massive amount of scale in this would be to do as many originations as possible. And we looked at it as almost a conflict. Like our interests wouldn't be really aligned with investors necessarily if we were
right.
had to go find borrowers to do that. We thought there was a risk of potentially having to drop our underwriting standards basically to be able to create that scale, to create a very valuable tech business and justify the massive valuations that you see, Right. So it was very important for us from that point of view. And then just functionally, as a business, be able to have a higher amount of deal flow is just better for investors to create that diversification aspect to it. So there's a variety of reasons why we structure things in that way, but it all comes down to trying to minimize risk for investors and kind of create that platform.
Right. Well, can you tell us a little bit about that platform? I'm curious. You've got one of your co-founders who, basically founded Google Analytics. So I actually was a client of Urchin's in 2003 onwards until it became Google Analytics. So
yeah,
I know Urchin very well. It was a great. I loved it, and then when it seems like it keeps getting better.
Yeah,
but
it's funny. Just kind of like a side note. Obviously, it's like such a ubiquitous kind of thing that like I can't tell you how many times. And Brett always gets very happy when it talks to somebody from the used Urchin back in the old days before the Google days, because it's obviously it's fond memories for him as creating kind of building this business. But
right.
Yeah, it's pretty amazing how many stories you hear like that. But
I know
when I get off, I'm going to tell him. He's going to be very excited that you're an Urchin user.
Right. Well, it's funny because I explain sometimes. They have that UA code on the Google Analytics when you're setting it up on your website, and that's an Urchin Analytics. It's sort of part of the history of Google Analytics. So.
Yeah, that's right. And this is. I hate pumping Brett up too much because it might expand his ego too much. But the old war stories, but. I think in most tags, there's the UTM tag that is in like the tag.
UTM,
so
exactly.
that was Brett is the one, at least he claims that he was the one that named that, because, back then they were just making up of like, all right, what is going to be the protocol of this? And, it's not, he always jumps on me, but it used to stand for it's not urchin tracking module, but it's something like that. It was like the original anyways, but so
anyway, we've lost people who aren't interested in analytics.
So sorry.
Anyway, no problem. I wanted to, my question is based on your tech platform. Now, I'm curious, given the history of your co-founder, I mean, what have you done on the tech side that really makes PeerStreet unique?
Yeah, I mean, there's a few things, and especially in real estate, it's very, very unique, I think. And it's a combination of the tech along with kind of the legal structure of the business. And, I talked earlier about how we're kind of from a investor's point of view, it's very similar to Lending Club and Prosper. But, a lot of real estate, traditionally real estate, you invest in a loan or a property, and you sign legal documents for that one property. You kind of wire money for that one deal. You get investment interest payments back or for that one particular deal. But our whole system that's kind of been built is effectively, like an E-Trade for investing in these real estate loans. And so it's very complex in terms of like the servicing of the loan payments and, the software that's been built under the hood to track all the payments. So, if you as an investor on PeerStreet, when you get interest payments, you can reinvest those interest payments into new loans in very small increments and without having to withdraw it from your account. So, interest payments come back. If you have 100 loans on PeerStreet or a piece of 100 loans, interest payments come back in, they get credited to your account. You can reinvest that into a new loan on PeerStreet to create a compounding effect. And that's pretty rare in real estate. I mean, normally real estate is, like I said, is kind of like everything segregated. So underneath the hood, it's a very, very complex kind of tech structure, both in terms of like how loans are processed, how loans are serviced for investors, the accounting software, all of the kind of payment portals between your external bank and City National Bank, which is our custodial bank. There's a lot of things in there that tech-wise are very, very complex. And then on the data side and the analytics side, obviously, valuing the loans and underwriting loans and our whole underwriting process of when loans get on and how we qualify them for inclusion on the platform obviously includes a huge amount of analytics and data and risk analysis on the loans when they come in, combined with traditional just boots on the ground, going out and looking at properties and putting a value on it. So tech kind of touches everything from when borrowers come on to when investors are making payments or taking withdrawals or doing whatever they are. So I think if underneath the hood, compared to anybody else out there operating on the real estate side online, I think it's a pretty different animal we've built.
Mm-hmm. Right. And it sounds like, as I said on your website, you're very much focused on investors. Can you give us a sense of who is investing with you today? Yeah.
So, we started, it's all accredited investors, obviously. We'd love to be able to open up to everybody, but, as you know, we're constrained by who we can allow on. Mm-hmm. So we started, we've been basically operating the platform for the past year. When we started, we were very private. We invited on kind of our own network of investors, which are all wealthy individuals and family office type investors. The first 12 months, we pretty much operated fully with high net worth individuals and family offices. And now it's running the gambit from those individuals up to, $500 billion fixed income asset managers that purchase on a whole loan program. So there's a mix.
Right. Now, because I think I signed up in 2014. We had to wait like 6 months, I think it was, before you let us actually onto the platform. But
if we were more on top of it, understanding that you're a peer-to-peer lending celebrity, we should have given you earlier access. So
No problem.
I apologize.
So can you give us some sense then of the scale you're at today? I mean, what did you do last year in terms of loan volume?
Yeah, so we don't talk too publicly about this stuff, but what I'll say is over the last 12 months, in that very private kind of beta, did over 50 million in the kind of the last 12-month period on the retail side of things, so on the retail platform. And then going forward, the demand that we have kind of going forward, both in terms of institutional and retail, is, should be in the hundreds of millions this year of originations.
Right. Okay. That's great. So, and as far as like your investors, I was doing a little bit of reading about you guys, and and I saw The Big Short the other day. And so it sounds like you've got, Michael Berry on your, investor team, who played by Christian Bale in the movie. And I just wanted to get, and I wanted to get sort of how did you find him? I mean, he's a real estate celebrity, obviously, for, he had the book and now the movie. It's, how did you get him on board?
Yeah, I mean, one of these just interesting things. I mean, I told you how back in not to go too far afield again on you, but when I talked about like when I was a real estate attorney and shorted all the banks and stuff and Fannie Mae and all that before the crisis, after coming out of the crisis and reading The Big Short, he was just a complete idol of mine of like, here's this guy who is, I mean, first of all, his whole story is insane that he dropped out of medical school at Stanford to his residency to go become this incredible hedge fund manager. And then he was in Cupertino and he wasn't on Wall Street. He was on Cupertino and figured out the whole thing. And he was the first guy. So I just always idolized him. And literally when early on, when Brett and I were putting down our list of like, hey, who would we like on our advisory board? Who'd be the number one guy? I put him at the top of the list. Turns out that Brett had invested in a business that Michael Burry had also invested in. So we got an intro to him through the founder of that business. And, we went in to pitch him. It was for me, it was like meeting like the Beatles, like an idol. I was very nervous. And, he's also known just for being extremely smart. And which is like, he's one of these guys, when you talk to him, when you're in the same room with him, you're like, this guy is on a different level. And, we were told when we went to meet him, he's like, it doesn't take a lot of time. It's, no small talk, just get right to it. And our first meeting ended up going 2 hours. And, I told him how I'd kind of come to my conclusions about the financial crisis and everything. And, we just we hit it off, and we asked him to be an advisor. And he said, well, if I'm going to advise, I'd also like to invest. And, he's been a great supporter. He's just one of these guys that he's just incredibly, incredibly intelligent. But in addition to, we have some other investors that are involved with that book too. But they've been asked to kind of not be broadcast too much. Okay. But in addition, but I mean, Michael Burry is clearly like the most well known, and yeah, he's just a phenomenally smart guy, and we're just thrilled that he's been involved and been a supporter of us.
Right. Okay, so before we wrap up, I'd like to ask you, what the future holds for PeerStreet. Are you going to stick with this residential fix and flip? Are you going to broaden your approach? What's on the cards for the next 12 to 24 months?
Yeah, I mean, the short-term focus is clearly on this short-term single-family residential asset class. I mean, when the time is right, and we would like to move into other asset classes, and we clearly look at longer-term buy-to-rent loans. We look at non-qualifying mortgages, and someday in the future, and I personally believe that every type of mortgage will be done through a platform like PeerStreet's, and hopefully through PeerStreet's platform, because at the end of the day, it's just a more efficient way to connect investors to a loan, right? And when you're talking about real estate loans and mortgages, it's one of the largest, most important financial asset classes in the world, right? I mean, the most liquid, largest, it's just an enormously important asset class. And so at the end of the day, we look at PeerStreet as being a better way for any investor to invest, because it's simply more transparent and more direct. If you think of it that way, and you think of the idea of somebody going in and having to spend 3 months of going through a process of getting a 30-year mortgage on a loan with a bank, just doesn't really make sense if there's investment demand for those type of mortgages. So, in the future, we'd like to do every type of mortgage. Now, next 12 to 24 months, we might just be doing single-family fix and flip and buy-to-rent or rehab loans, because it's just a great, great asset class. We just think that, when underwritten correctly in sub-markets that are healthy, it just provides the best risk-adjusted returns for investors. So when the time is right, we'll get in other asset classes. But for right now, everything points to this being the right place to be. So. Okay.
So last question. It's no secret that there's a lot of real estate platforms out there today. And, you guys obviously have a bit of a unique approach. But I'm curious, how do you differentiate yourself from all of the competitors out there?
Yeah, I think we know very, very much how we're different. And the main reasons we're different is that we don't originate our own loans, which almost sounds counterintuitive, but that's actually like we think is a big value prop for investors, right? So we don't originate our own loans. So that's clearly like the biggest differentiator. I think almost everybody, I think we're the only ones that do not originate our own loans and are very proud of that.
Right.
Now, our returns are a little lower because we don't do that, both for our business, but we just think it's offset by the risk mitigation. So that's the clear one. And then the second one is that we're just 100% focused on 100% on first position lien real estate loans. So the safest part of the real estate capital stack. So, I don't think anybody else everybody else is originating their own loans or their own deals. PeerStreet is not originating, and then we're also focused. Whereas a lot of other players out there might do, first position liens, equity investments, preferred equity, and do a little more kind of broadly. We're just very, very focused on the asset class we're dealing in.
Right. Okay. Well, on that note, I'll let you go. I very much appreciate your time today, Brew.
Yeah, great, and thanks for having me. I mean, I told you I didn't tell you before you started, but when I talked about like in 2008, 2009, working up kind of a business model similar to what we're doing, I've been following this space for a long time, and I've been reading your stuff for so long. It's crazy. I feel like I know you already. But the thing that I also love about your particular story and like how you've done this is that like it's just like almost a great like modern day like internet kind of thing where something new is out there. You find information about it. You create this brand and this great kind of business on it. You provide a lot of information and value to people out there. I know the whole arc of your particular career in the marketplace lending has been awesome. And I mean, I remember
I'm blushing.
I remember, wow, but it's great. I mean, I remember even like reading like a report you did on like the London Lend It a couple years ago and kind of going through a bunch of things. And I was like, wow, what a service this guy is providing, and everything you've done, obviously with all this stuff, has been great. So, anyways, I'm very, very happy you reached out and we could do this.
Okay, great. Well, on that note, thanks a lot, Brew. Appreciate your time.
Good, Peter. Talk to you later.
Bye. So one of the things that I like about this new way of doing real estate is, we touched on the financial crisis and we touched on the big short and how the run up in housing, was one of the major triggers of the financial crisis. Now, I'm struck by the fact if we had had a system in place where the vast majority of lending was done, or a large part of lending was done by platforms like PeerStreet, like these online platforms, there simply would not have been a financial crisis like this. And I think there wouldn't have been a need to bail out anybody. And that's where I think the promise of this, we're just getting started here. We're talking about something that's going to go on for many decades. And I'd like to think that eventually, while there will be bank loans done probably for the next 100 years, I like to think that a lot of the system is going to be done, a lot of lending is going to be done through these online platforms, and that's going to be a safer way for our economy to operate. Anyway, on that note, I would like to thank you very much for listening. I very much appreciate it, and I'll catch you next time. Bye.